So I know that the title of this episode is How to Calculate Yield on Your Investment Property, but I just want to back up and tell you what Albert Einstein can teach you about property investing. I think this is related and incredibly important. Albert Einstein once said that compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Now, it's easy to sort of brush off this as another sort of clever quote that PK's come up with, but here's where most investors risk their profits. Compounding interest is more than just numbers compounding over time. It's about growth, not linear, but exponential. And that's how it comes to yield. I'm going to go there in a second. Compounding interest is the silent, persistent force that can either work for you or against you. The upside, imagine planting a tree in your backyard. At first, it's a sapling. But with time, it grows branches, then sub-branches, and then those branches grow their own sub-branches. This tree doesn't just grow upwards, but starts spreading outwards as well. So its growth mirrors how compounding interest multiplies money. When you invest wisely and let your returns compound, your initial amount starts bearing fruit, and then that fruit bears its own fruit. Your money isn't just growing, but it's multiplying. The downside, yes, there's a downside. Loans, credit card debts, and other borrowings, when you don't manage it well, they compound against you. And that's when compounding interest becomes a silent predator, growing and lurking in the shadows of your finances. So what started as a small debt can quickly spiral out of control. I'm sure a lot of you have experience with this. So here's the big question, right? Are you harnessing this powerful eighth wonder, or are you shackled by it? It's crucial to educate oneself to be on the right side of this equation, because the reality is that compounding interest waits for no one. Time and tide waits for no man. Same thing with compounding interest. It's always at work, day in, day out, silently shaping our financial futures. Even if you're not investing, you're not doing anything, it's still working, but it's just against you. You can start making compounding interest work for you, though. You can start making it your ally, and that begins with knowledge, with understanding the math behind it, of course, and with making informed choices. I'm trying to help you, guide you on that path in this episode, to not just show you the numbers, but to empower you so you can take control, to make sure that you're the one earning the compounding interest, not paying it. And the way that this all relates to rental yield is calculated as your annual rent. Let's say it's $1,000, just so I can do this in my head real easy. It's not likely to be $1,000, but let's say it's $1,000 a week, and then times that by 52, because there's 52 weeks in a year. So that makes it $52,000 a year. Okay, that's your yield. And let's say you bought a property, for, let's say, $1 million, right? So you divide that 52,000 over $1 million property, and it gives you 5.2%. I think that's 5.02%. Okay, that's your yield. Hopefully I haven't screwed that up, but you get the point, right? Annual rent at the top of the fraction, your property purchase price at the bottom of the fraction. You divide the two together and you get a percentage. And the really important thing to understand as it relates to compounding interest is that, yes, your rent isn't going to compound. It's not like it's going to go up by $20 this year, and then $40 the following year, and then $80 the following year, and then go up again $150 the following year, right? That doesn't really happen. I'm not going to lie and make stuff up, right? That's not going to happen. What is likely to happen is it goes up, let's say $50 this year, then $30 the next year, and then $40 the following year, and then $35, and then $65. So it kind of jumps up and down, but sort of consistently in a linear way, it sort of goes up. But if you think about it, that's going up on the basis of your entire property purchase, that entire $1 million, or, in that example I use, $1 million property investment. Not that you need to be spending $1 million on a property, $500,000 property investment, $400,000 property investment. But remember, to buy something for $1 million, you only needed like $120,000 deposit plus stamp duty, plus a few transaction fees like legal fees. To buy a property worth 400K, you only really need like $75,000, 12%, 10, 12, 15% deposit, depending on your strategy, legal fees, transaction fees. So what does that tell you? On the initial down payment, on the initial capital required, that rent is just compounding your returns, because that rent is going up almost on a yearly basis if you buy well, but it's going up on its previous growth, and that's how compounding works. So you can be either on the right side of that equation or the wrong side of that equation. If you're sort of wondering, hey, look, I don't know whether I want to be a property investor, you're putting yourself, let's be honest, right, on the wrong side of the equation, because every year house prices, almost every year they go up, rents go up almost every year. So if you don't have skin in that game, it's almost like, the party, the show goes on with or without you. And remember this concept of compounding, this eighth wonder, as Einstein said. If you buy multiple assets, if you've got 1, 2, 3, now 4, now 5, now 6 properties, and all of those experience growth in their rents on a yearly basis according to whatever the market dictates, and you've only required 10 to 15% of the purchase price of the property to control all those assets, now you've got compounding on steroids. Okay, every property, the rent's going up on a yearly basis, and you've got multiple properties. Okay, it's not like you needed 500K to buy a $500,000 property. If you have 500K, just to use an example, you can buy $10 million, that's probably not true, $5 million worth of property. Okay, that's how compounding really kicks in. And then the third layer of compounding, right, is to say that not only are those rents or that passive income going up, but also the property prices are going up, and they go up, let's say 7 to 8% on average over the long term, last 30, 40 years. If you took it a 90-year history, it actually goes up 11% per annum property prices. So now you've got this third layer of compounding where that initial, call it 70,000, 60,000, 50,000, 80,000, dollars that you required to buy a $350,000, $400,000, $500,000 property, that is now going up so much more across multiple properties. And you're just basically it's raining cash. All right, and of course we need to do this in an ethical way, but this is what Albert Einstein meant by compounding, not only the rent, but the multiplication of assets, and then the house price growth, and it just goes up and up and up. So you can think about it like this: there's two types of people in this world. One who's very skeptical of everything, including making money, because they've always been taught that the way to get ahead, to make money, or to have more money, is to save money. Okay, how does compounding work for these types of people? It also works, right? You put it in the bank and you get your interest in it, and it compounds. But there's no leverage in the bank. If you can leverage safely in an educated, calculated way, then you've got 3 ways, 3 versus 1, 3 obviously wins over the bank account, 3 ways that you're compounding money. And it's, it's amazing what $50,000 can get you in 10 years and 20 years and 30 years if you just have some skin in the game. Now remember, Yield, what I've just mentioned before, is gross yield. There's also a concept called net yield, which means that after, like in a typical property, you've got your gross yield, let's say it's $500 per week, and then that needs to be assessed for what it actually gives you at the end of the day on a net basis. So there's kind of like maybe four or five main things that you need to be conscious of. One is insurance, both building insurance, in case there's a fire, house burns down, etc., and landlord insurance. Building insurance is normally between $2,000 and $4,000, depending on where you buy around Australia. I'm talking a sort of standard $500,000 type home. And then your landlord insurance is normally between $200 and $500 per annum. So you've got insurance to not worry about, but to factor in. The other thing you've got to factor in terms of getting that gross yield down to a net basis is, of course, management fees, property management fees. I always recommend using a property manager. They know so much more than you and I. We're not across the legal and regulatory changes on a weekly, monthly, yearly basis. So many other things they do beyond just collect the rent. Okay, big fan of property managers. Property management fees can be anywhere between sort of 6% to almost 12%, depending on where you buy across Australia. That's a percentage of your total rent. And so that's the second thing you need to be mindful of. Of course, another thing you need to be mindful of as well is maintenance fees. If I look at my own property portfolio, and I'm not making this up, across sort of 12, 13 properties, let's just say investment properties, so 12, I've owned them since 2011, well, that's when I got my first one. I would say it averages between $1,500 to $2,500 per year per property for maintenance. All right, so management fees, you've got insurance, you've got maintenance, and then there's obviously your interest repayments, or principal and interest repayments. If you just go interest only, that's obviously based on the prevailing interest rate. Then you've got principal as well. If you're already accumulated all the properties that you want to, and now you're retiring debt, or you're not looking to leverage up, you just want to consolidate your assets, get ready for that passive income into retirement. That's obviously another fee or another thing to be mindful of. There's some others as well. This isn't a comprehensive list, but like budgeting for vacancy. I always budget for 2 weeks of vacancy every year. I don't think any of my properties have ever had 2 weeks of vacancy, and it all comes down to where you buy, what you buy, for the local demographic, if it's attractive, how you maintain it, how you treat your tenants, etc. But I always, on the safe side, budget for at least 2 weeks of vacancy. So those are some of the things, not all of the things. There's some bank fees, not so material in the context of things, but that's some ways where you can take that gross yield down to net yield. But remember, your rent goes up almost on a yearly basis, especially in this next decade. There's a rental crisis in Australia, so we're not trying to, be greedy landlords, but according to what the market conditions are, according to what the interest rates are, according to what tenants can reasonably afford, we raise rents, and therefore you get that benefit of compounding interest. The house prices go up, get that benefit of compounding interest, and if you can own multiple assets, then that compounding interest compounds even more because you've got more skin in the game. So that's really the eighth wonder of the world, as Einstein said. I really want to, once again, I don't want to try sell this too much. I don't want to be forceful or anything, but I just want to be open and honest, and once again reiterate that there's two types of people. One type of person that will consume so much of this type of content, but still that eighth wonder of the world will be a predator on their finances because they won't actually take advantage, be on the right side of the equation to receive the benefits of compounding, because they just don't have confidence. It's like a subliminal, there's a subconscious, maybe from their childhood, or maybe from the association that they have, or maybe from the experiences that they've been through. They just won't take that step into investing into the Australian residential property market, which is basically as blue chip an asset, if you look at it over the last 60, 70 years, as you can get globally. Then you've got the other side, where, well, on the far side, you've got people who'll just put a blindfold on and put money into Perth, without considering anything just because it's booming. That's not recommended either. Try be in the middle ground. I'm not Buddhist, but Buddha always said, this came to my mind randomly, the middle ground, the way of balance. Try to be in the middle. Take action, be reasonable, be educated, be calculated, be ethical. That's the middle ground. You make money, and the eighth wonder of the world works for you. Hit the subscribe button if this gave you any value. Give it a like. My name's PK, and thank you for being here. Cheers, guys.